Hello, Leeb Group viewers. Welcome to Leeb.com, Leeb.com. Make sure you drop by, sign up for our free financial newsletter email, receive a free stock market report chock full of great information. So the IMF has slightly raised its 2011 outlook for world economic growth. That's good news. In projections released 3 months ago, the IMF called for a 4.2% growth for the year. The projection has now been bumped up to 4.4%. Not surprisingly, emerging markets will continue to lead the way, with developed economies lagging behind. Despite the upward adjustment, the IMF warns that risks remain elevated. While developed countries face debt problems, emerging countries have asset price bubble risks stemming from overheated growth. The extension of U.S. tax cuts largely accounted for the growth upgrade. On the topic of growth, normally beating expectations is regarded as a positive. In China's case, however, investors didn't seem to like the report that the Chinese economy exceeded a 10% growth rate last year. With the Chinese government highlighting inflation control as a primary objective, the fear is that the overly strong growth will fuel inflation, forcing the government to apply more pressure to the brakes, and this could potentially go too far and sap growth, from not the Chinese economy. With China being the key global growth driver, a major slowdown there could inevitably have adverse effects worldwide. Recent data showed that the consumer level prices in China declined to a 4.6% year-on-year rate in December, down from a 2-year high level in November. The less heated reading could give Chinese policymakers some leeway to not pursue extremely aggressive tightening actions, as it's also not in China's interest to risk having its growth rate decline too much. China will still likely grow at a rate north of at least 8% this year, hardly what one might consider stagnant growth. China's fundamentals look intact. Thanks for dropping by, and we will see you tomorrow.